Good morning, everyone. Welcome again to this session on strategic financial management, valuation of equity shares. Today's lecture will be on valuation of equity shares, but in my previous lecture, I have explained you the various concepts of fundamental analysis, and I have given you one assignment on fundamental analysis also. So I'm sure you have gone through that. And I will take a few minutes to discuss this. Then I will begin the session on valuation of equity shares. If you see this, the first question, which is there in your assignment on fundamental analysis, that is, India's GDP growth rate is expected to decline this year from what it was projected before in view of the frightening second wave of the pandemic. Considering the present situation, what will be your likely forecast for the India's economic situation? So, if you can analyze what is the present economic situation. The economic situation during the pandemic was bad. Okay, and there was lockdown. People lost their jobs. People were receiving less salaries. But now the economic situation is gradually improving. The International Monetary Fund has also predicted that India will grow at about 9.5%. World Bank has also projected that the India will grow at about 8.5%. So economic situation is looking more or less on the, you can say, recovery path. But what will be your expectation from the Indian economy? If you see the present trend, the growth of high-end goods, that is the luxury cars, the luxury houses, the luxury items are actually, demand for those items are increasing. What is the reason? The reason is that the senior positions in the corporate are actually earning more. And because of that, the luxury items, the demand for luxury items are increasing. On the other hand, the demand for low-end goods, that is affordable housing, low-end cars, affordable cars, and other items are actually decreasing. So this is the situation for the Indian economy at present, and the likely forecast, I think it will happen for the what we can assess from the current economic situation, that it will continue for some time to come, maybe for 6 to 8 months for the next few years, unless you can say the employment situation improves and the inflation also comes down, because right now the inflation for the vegetables, inflation for the grocery items are quite high. Now come to the second question, that which industrial sectors are likely to do well in view of the present pandemic situation. We have discussed that during our lecture in fundamental analysis, that what are the sectors which are likely to do well. If you have gone through the various newspapers, that government is giving a big boost to the infrastructure sector, that is infrastructure in the sense modernization of the railways, modernization of the, you can say, railway platforms, railway stations, modernization of the airports, ports, various highways, tunnels. For this purpose, what are the industrial sectors which are likely to be benefited because of this infrastructure push by the government? The few sectors which comes to mind is the cement sector, the steel sector, metals, the real estate, even banks, because you can say the companies will require loans, require funds in order to fund this infrastructure projects. So private banks are also expected to do well. So these sectors, industrial sectors, are likely to do well. Another aspect is the government's PLI scheme, that is government's production linked incentive schemes. Under this scheme, the government is giving, you can say, boost or giving or encouraging the sectors, domestic manufacturing sectors, that is the domestic manufacturers who are engaged in the manufacturing of mobile phones, computers, textiles, shoes, etc. So these sectors are likely to do well in the future also, next 6 months or so. Now come to the third question, which is based on company analysis. I hope it is now visible to you. So, in this case, the sales EBIT figures are given, interest expenses are given, you can say EPS, dividend payout, fixed asset, current assets, liquid assets, current liabilities, equity, debt, and cash flow from operating activities are given. Now, I have explained to you and we have discussed that during the course of our lecture on fundamental analysis, that first of all, we assess the company on the basis of profitability, then we assess it on the basis of solvency, then we assess it on the basis of the liquidity. Now, from sales, if you the sales is increasing, increased about 14,000 in the third year, then it again decreases, and then it shows an increasing trend. So what is the average, you can say, profit for the last 5 years? It is somewhat on the increasing trend. One way to assess that is to calculate the compounded annual growth rate. So I have given practical examples also during my course on this fundamental analysis. So how it is calculated? It can be calculated with the help of the Excel sheet. Let us copy from this and go to the Excel sheet, paste it here. We will calculate the CAGR, that is compounded annual growth rate. We will take the end figure, that is F3. We divided it by the initial figure, which is B3, bracket close, and then raised to the power 1/4. We have taken 1/4 because it is compounded for actually 4 years. Then minus 1. So it is growing at about, you can say, 3.1%, 0.03 to 3.1%. So again, let us go to the assignment again. Let us take the EBIT figure. EBIT figure is more or less growing at the same rate, not showing any significant trend. So let us copy it and paste it in the Excel sheet. So let us see what is the CAGR of the EBIT figure. Paste and Control D. So this is the sales figure. Sales. This is EBIT. And one more figure we will take, that is the EAT, profit after tax. Just copy it and paste it in the Excel sheet. Again, this is Control D. So see that profit after tax is actually increasing. It is 17.67%. So EAT, profit after tax figure is good. Sales figure is okay. EAT figure is okay, but EAT figure for the last 5 years, profit after tax is actually on the increasing test. So what is your conclusion? Your conclusion can be that yes, the profitability position is, you can say, it is okay. Now come to the solvency situation. Let us assess the solvency situation. If you see the company debt equity ratio, debt and equity, debt is higher than the equity. In some cases it is 2:1, in some cases it is less than 2:1. But if you see that the company has actually reduced its debt, because if you see the first year, the debt equity ratio is more than 2:1. But in the 5th year, the debt equity ratio has been reduced. It is less than 2:1. So if you see that if it is a capital intensive company, it is a manufacturing company which is investing hugely in the fixed assets, then you can say that the debt equity ratio is okay, can be considered as okay. But another factor which should be judged along with this debt equity ratio is the interest coverage ratio. That is whether the EBIT is sufficiently covering the interest expenses or not. Let us see. You see the EBIT figure here. So EBIT figure and the interest expenses. If you see that the EBIT is sufficiently covering the interest expenses. The fifth year, if you see that the EBIT figure 1677 and the interest expense 490, it is sufficiently covering the interest expenses. So interest coverage ratio, as you know, it is EBIT upon the interest expenses. So it is sufficiently covering the interest expenses. Fine. So what is the conclusion? You can say yes, the solvency position is also okay. Considering that it is a capital intensive debt equity ratio, but company has reduced its debt also during the course of. So you can say that yes, the solvency position is okay. Fine. What next? The next is the liquidity position. We will judge the liquidity position of the company as well by doing the company analysis. The main ratio, which is current ratio and liquid ratio. So current asset figure is given, current liability is given. You see that it is not 2:1, but it is higher than 1:1. In some years it is 1.5:1 also. So you can see that yes, the working capital is efficiently utilized, then the current ratio is also okay. Let us see the liquid ratio, that is liquid assets upon current liabilities. It is all the years it is near about 1:1, slightly higher than 1:1. So liquid ratio is good actually. So you can say that the liquidity position is actually good. The liquidity situation is actually good. So liquidity is good. Now what remains? It remains as the cash flow from operating activities. So as we have discussed, the cash flow from operating activities should be positive. So in all the years, the cash flow from operating activities is positive. So cash flow is also, you can say, good. The cash flow from operating activities is also good. So what will be your overall decision whether to invest in the shares of that particular company or not? It depends. If you are okay with the profitability position, which is not very good, but okay, solvency position is also okay, but liquidity is good, cash flow is good. So your first emphasis should be on a company which is cash flow position is good. If cash flow position is good, then you can consider investing in that company. But along with that, the management analysis is important. So if the management is good, the management is trying hard that the company will grow in the future, then you can consider investing in such companies. Otherwise, it is better to avoid such a company. So this is what the company analysis is in case of this assignment question. So any question in regard to that, the assignment? I hope it is more or less clear because we have discussed this fundamental analysis chapter in great depth. Even if that, any question is highly welcome. Otherwise, I will start with the valuation of equity shares. Yes, Sairam, I will do that. Just give me a second. I will do the calculation. Yes, the sales figure compounded annual growth CAGR is, the formula is this, that is we take the end value, that is F3 divided by B3, that is the initial figure, and then raised to the power 1/4 minus 1. In some cases, some of the expert also takes 1/5 also, but it is better to take 1/4 because the sales of the compounding takes place the next year itself. So it will be for 4 years. So it is better to take 1/4. So the formula is the initial figure divided the closing year upon the initial figure raised to the power 1 upon 4 minus 1. Okay. I hope now the Excel sheet is visible to you. So what I am telling is that this CAGR formula is this. You take the end figure, divided it by the initial figure, raised to the power 1 upon 4 minus 1. Okay. I hope it is clear now, this CAGR aspect. So shall I proceed now? This is the assignment. Anything which you want to ask in this? Okay. Fine. So I will stop sharing it and I will go to the PPT to start the valuation of equity shares. Fine. In valuation of equity shares, we shall start with some of the basic concepts which you have read in your intermediate course also. But let us just refresh it. That is the required rate of return, discount rate, and the internal rate of return. Required rate of return, as you know, is the minimum rate of return which an investor is expected to receive while making an investment. For example, if an investor wants to invest in the equity shares, whatever return he wants to expect in the form of dividend, then it will be his required rate of return. As you know, this is also called the opportunity cost or cost of capital because it is the highest level of expected return foregone, which is available elsewhere from investment of similar risk. Now, discount rate and minimum required rate of return are one and the same thing because whatever return which the investor is expecting, it is actually used as a discount rate, which is used to discount the future cash flows. So, the discount rate is the rate used to calculate present value of future cash flows. So, discount rate also depends on the risk-free rate and the premium of an investment. Actually, each cash flow stream comes from different assets that can be discounted at a different discount rate. We will see that the discount rate can be calculated. An interesting point to note here is that the discount rate in case of valuation of equity shares can be calculated by two methods, that is Gordon's model and the CAPM model, that is capital assets pricing model. In Gordon's model, the risk is not considered. This is risk-free. But in case of CAPM model, that is the capital asset pricing model, the risk is actually considered. I will explain this when I will take the slide on equity risk premium. It will be then more clear to you. Let us just move forward to internal rate of return. Internal rate of return, as you know, is the discount rate which actually equates the present value of cash flows with present value of cash outflows, inflows and outflows. Or it is the discount rate at which the present value of future cash flows of a security equals to its market price. So an IRR, that is the internal rate of return, is also viewed as the average annual rate of return that investors earn over their investment time period, assuming that the cash flows are reinvested at the IRR, that is the internal rate of return. So now come to the equity risk premium. I will take some time to explain this, the equity risk premium aspect. Okay. So let us stop sharing it. I will go to the whiteboard to explain this concept, the equity risk premium. what I was telling that in case of discount rate in case of valuation of equity shares can be calculated by two methods. First is the Gordon's model. Which is actually, if you can recall, D1 upon P0 plus G. So this is actually a risk-free model in which the risk is not taken, the Gordon's model. Another way to calculate the discount rate is to consider risk, which is the CAPM model. CAPM model, which is the capital assets pricing model, which is calculated as RF plus beta multiplied by RM minus RF. And this RF is actually the risk-free rate. RF is the risk-free rate. Beta actually shows the volatility. That is how volatile stock is in comparison to market. Market means the National Stock Exchange or the Bombay Stock Exchange. So if you can say the market is NSE is actually increasing at about in the last 1 month at about 10% increase at about 10%, and the stock of a particular company, say Tata Motors, have increased by 12%. So you can say that the share of the stock of Tata Motors is volatile. So beta is more. The beta will be more than 1. So this is what beta is. The calculation and detail calculation of beta will be considered in the you can say the portfolio analysis, the chapter. Now RM is the market rate. RM is the market rate. That is what is the NSE or the BSE is offering. So now take a brief example to understand this and just understand the concept of the equity risk premium. Let us say the risk-free rate is 8%, beta is 1.2, market rate is 12%, and this risk-free rate is actually 8%. So we take a brief example that this risk-free rate is 8%, beta is 1.2. It means the stock is more volatile, and the market rate, that is, for example, the stock NSE is offering 12%. Let us calculate it. into 4, it will be 4.8. Let's confirm it. So it's 4.8. So 12.8%. So cost of equity or minimum required rate of return, both of them are same. So what this amount is, 12.8%. 12.8% is actually you can say cost of equity or the expected rate of return. Or the expected rate of return. So cost of equity can be calculated by this method also. Now what is the equity risk premium in this case? The equity risk premium is 4.8%. It is the equity risk premium. And this 4, that is 12% minus 8%, is the market risk premium. Means if an investor wants to invest in equity share, the market is offering 4% more. That is, this 4% is actually the market risk premium. Market risk premium. This is market risk premium. So, equity risk premium is 4.8. It means the investor is investing in the equity share because he is getting a premium of 4.8% by the risk he is taking in the investing in equity shares. So this is the equity risk premium, that is the premium or the advantage he is receiving by taking the risk by investing in the equity shares. And this is the 4, that is 12% minus 8% is 4% is the market risk premium, what the market is offering, what the premium market is offering if one is investing in the equity shares. And this 4.8%, there is equity risk premium is more than the market risk premium. If you can observe, it's mainly because of the beta, volatile, because the stock is more volatile. The stock is increasing at an increasing rate in comparison to this market. As I explained, that if, for example, the Nifty has been increasing at 10% and the shares of Tata Motors increasing at about 12%. So shares of Tata Motors in this example is actually more volatile. So in this case, the beta will be more. So this is what is the concept of equity risk premium. And if you have any further queries in this, we'll be happy to attend that. Okay, Saram, I will try to use a more darker marker so that it can be more clear to you. If anything, if you are not able to understand, you can ask also. I hope it is more or less clear. Now let us, shall I go back to the PPTs now? Okay. Fine. Now just go to the next slide, that is required return of equity. Now this slide will be more clear to you as you have understood what equity risk premium is. Now required rate of return can be calculated with the help of capital assets pricing model also. If the project is risky. As we have discussed, that cost of equity can be calculated with the help of Gordon's model also, which is risk-free. Risk is not considered in the Gordon's model. Or it can be considered with the help of capital asset pricing model also, in which the risk is considered. So your question will be, what which should be actually used by an investor, that is Gordon model or the CAPM model? The answer is, if the particular company is utilizing the amount which it has raised by way of equity in a risky project, then applying the CAPM model is viable. On the other hand, if the company is utilizing the, you can say, raise the funds by in a project which is not so risky, then the Gordon's model can be used. So it depends upon whether the project is risky or the project is less risky. And the main insight of the CAPM model is that the investors evaluate the risk in terms of the asset contribution to the systematic risk of their total portfolio. Now, this is another important factor, that the systematic risk. Systematic risk means those risks which cannot be reduced by the portfolio diversification. As you know, most of the experts generally tell that an investor should have a portfolio of about 15 to 20 stocks. So if some of the companies do not do well, if some of the companies do not get good return for you, then other companies can more than compensate for you. So overall, you will get a decent return by minimizing your risk, by diversifying your portfolio, including at least 15 to 20 companies, a stock of 15 to 20 companies in your portfolio as an investor. So this can be reduced, but some of the risks, which are called systematic risks, cannot be reduced by diversification of portfolios, such as you can say yield, the bond yield raised by the USA, for example. So what it will cost, as I have also discussed this during the course of fundamental analysis also, that if the bond yield is increased in the USA, so it will force the foreign portfolio investors to you can say withdraw some of the funds from the Indian stock market and invest in the USA, because in the USA the bond yield has been increased. They will be getting more return if they invest in the US bonds. So if they withdraw money from the Indian stock market, the prices of shares are likely to may come down. So this would affect the Indian stock market, but such risk cannot be reduced by diversification of portfolio. So such risks are called systematic risk. So main insight of the CAPM model is to evaluate the risk in terms of assets contribution to systematic risk. It considers the systematic risk, this CAPM model. Now, CAPM model provides a relatively objective procedure for required return estimation. So it has been widely used in valuation. So the CAPM model is more popular in comparison to the you can say Gordon's model in the practical situations. Now come to the discount rate selection. Cash flows are discounted at a suitable rate to arrive at the present value of cash flows, which will be available in the future, as we have discussed. That is, the future cash flow in the form of dividend are discounted to arrive at the present value. Now, let us get to the second point, that when cash flows are available to the equity shareholders are discounted, the required rate of return is an appropriate discount rate. Further, when cash flows are available to meet the claims of all the company stakeholders, then the cost of capital is the appropriate discount rate. So, if the company has raised funds, if the company has raised funds by issuing equity shares, then cost of equity will be the discount rate. If the company has raised funds by way of both debt and equity, then the weighted average cost of capital or cost of capital is the appropriate discount rate. Now, the concept of nominal cash flow and the real cash flow. As you know, nominal cash flow is the amount of future revenues the company expects to receive without adjustment for inflation. So, in nominal cash flow, it is the before inflation amount, that without adjustment for any inflation. On the other hand, real cash flow shows the company's cash flow adjusted for inflation. So, it is the cash flow after adjustment of inflation. That is the real cash flow. Now, since inflation reducing the spending power of money over time, the real cash flow shows the effect of inflation on a company's cash flow. Now, which discount rate to be selected in equity valuation? That is the pertinent question. For nominal cash flow, logically the nominal rate of discount is used. For real cash flow, real rate of discount is used. But what about valuing equity shares? Which discount rate should be used? While valuing equity shares, only nominal cash flows are considered, and therefore only nominal discount rate is considered. What is the reason? The reason is tax, because the tax applying to corporate earnings is generally stated in nominal terms. Therefore, nominal cash flow in equity valuation is the right approach. I repeat, the nominal cash flow in equity valuation is the right approach because it reflects taxes accurately. So, nominal rate of discount is used in valuing equity shares. Now come to the valuation of equity shares. In order to undertake equity valuation, there are three methods in which the equity shares can be valued. That is dividend discount model, earning based model, and the cash flow based model. We will take all the three in a sequential manner. First, we will take the dividend discount model. Then we will take the earning based model, and lastly, cash flow based model. Now come to the dividend discount or dividend based models. There are basic three assumptions in dividend based models. First assumption is that the dividend are paid annually over an infinite period. This is the first assumption which is taken. Unless this assumption is taken, the dividend discount model cannot be used. Infinite period means the dividend will be paid annually over a long period of time, very long period of time. Second assumption is that the payment of first dividend shall be made at the end of the first year. And third assumption is that the sale of equity share shall be occur at the end of the year. So these three assumptions in the dividend discount model is very important. Dividends paid annually over a long period of time. Dividends will be paid at the end of the first year, and the sale of equity share will happen at the end of the year. Okay. Now come to the dividend discount model, and what is the discount rate which is used? The discount rate which is used is the cost of equity capital, because we are valuing the equity shares. Now come to the various aspects of this dividend discount model. The first aspect is valuation, which is based on the holding period of 1 year. Now, if the you can say investor wants to hold the share for 1 year only, this computed as follows. That is D1 upon 1 plus KE plus P1. Actually, I will take a few minutes to explain this, and I will take a practical example if the equity shares hold for 1 year only. So let us stop sharing it and go to the whiteboard. So if the shares can be valued, valuation equity share, that is P0, that is present value of equity shares. How it is calculated? D0 into 1 plus G upon 1 plus K. D0 is the current dividend and G is the growth rate. G is the growth rate and D0 is the current dividend. Okay, and K is the cost of equity. So the present dividend, current dividend, when multiplied by the growth rate will be the dividend at the end of the first year, which will be D1. This can also be written as D1 also. So I will again repeat it. D0 into 1 plus G upon 1 plus K, that is dividend received at the end of the first year, is discounted by this discounting rate to arrive at the present value of equity shares. Plus, now take the dividend of the second year, 1 plus G growth rate 1 upon 1 plus K plus D0 1 plus G 3 and so on. So it is dividend for the second year. Discount rate will be used to arrive at the present value. Dividend for the third year, this present discount factor is used to arrive at the present value. So this way it is calculated, and there is a shortcut formula also, that is D1 upon K minus G, dividend at the end of the first year, and this is discounted to arrive at the present value. So this is the, you can say, shortcut formula of this governance model. Or it can also be written as D0 1 plus G upon K minus G. So either it can be written as D1 upon K minus G or D0 into 1 plus G upon K minus G. Okay. Okay, Devil, I will answer your question. Let us first explain this. Fine. So now it is more or less clear to you. Let us take example. If an investor holds the share for 1 year only, if shares are held for 1 year, holding period is 1 year. So how it will be calculated? How present value will be calculated? Present value will be calculated as D0 1 plus G upon 1 plus K plus P1 upon 1 plus K. So first of all, dividend which is received at the end of the first year will be discounted by this cost of equity to arrive at the present value. Then the price which is at the end of first year will be discounted to arrive at the present value. Why P1 is taken? P1 is taken because the investor wants to hold the share for 1 year. After 1 year, he will be selling the shares. Now take an example of this. Let us say dividend is 5 after 1 year. After 1 year, the dividend is 5 and price is 20 after 1 year. And discount rate, that is K, is 20%. Now let us take an example that the dividend is rupees 5 after 1 year. Price is 20 after 1 year. That is, this is the price at which the investor will be selling the shares at the end of the first year. And K, that is cost of equity, is 20%. So let us apply this formula. So dividend D0 into 1 plus G, or you can also write it as D1 also, right? Dividend at the end of first year. Since dividend is given at the end of the first year, so you can directly take 5. So this 5 upon 1 plus K is 20%, 0.20, plus P1 is also 20 divided by 1 plus K, that is 1 plus 0.2. So it will be 25 upon 1.2. So let us calculate it. So it is coming to about 20.83. 20.83, the value of equity shares. So by this way, it is calculated. If the investor wants to hold the share, so how we have done that? The dividend is 5 after 1 year. Market price after 1 year is 20, at which the investor will be selling, and cost of equity is 20%. We apply the formula. D1, dividend at the end of the first year, 5 divided by the discounting factor. Then again, price at the end of the first year divided by the discounting factor, 25 divided by 1.2, and the present value of equity shares, if the shares are held for 1 year, is 20.83. Okay. Okay. They were asking a question that how can differentiation be done between the nominal rate of discount and the real rate of discount. While valuing equity shares, it is absolutely clear that yes, the nominal rate of discount is used. And generally, it is given the question also whether it will be real rate of discount is used or the nominal rate of discount is used. And if inflation is considered, then after adjusting the inflations, then the real rate of discount will be used. Okay. So let us continue that. Jigar, it is the whiteboard, whether it is visible, what is written there, whether it is visible. Jigar, I am audible. Jigar or Mansukh, am I audible? So fine. Okay, I will continue and try to, I will write in bolder so that you can see the whiteboard clearly. So let us continue with it. Okay. Now come to valuation based on the multi-holding period. In this type multiple holding period, there are three dividend patterns, that is zero growth rate, constant growth rate, and variable growth rate. Zero growth rate means the company is paying dividend at a fixed rate every year. For example, a company ABC is paying dividend at the rate of 10% for 10% every year. That will be the zero growth dividend. And in this case, the formula is P0 is equal to D upon KE. In this case, there is no D1 because the dividend is not changing, dividend is fixed. So P0 is equal to D upon KE. So zero growth formula is actually more or less easy, but actually it is very impractical because most of the companies actually declare dividend at a varying rate or at a different rate. So zero growth rate is actually you can say an impractical assumption, but if zero growth rate is taken, then I will take an example to actually explain this, the zero growth rate. So let us move to the whiteboard again. Let us take an example of this zero growth rate model. Now let us go to the zero growth rate model. Now let us take an example. Dividend is 20% and face value is 100 and the required rate of return KE is 15%. So under the zero growth rate model, let us take an example. Dividend is 20%, face value is 100 and the KE is 15%. Formula is P0 is equal to D upon KE. D is, dividend is always calculated on the face value. So it is 20% of 100, it is 20 divided by KE, which is 0.15. So let us calculate it. 20 upon 0.5 divided by, so it is 133.33. 133.33. So zero growth rate means company is paying at a fixed rate every year. So I will move to the PPTs again. Fine. Now come to the constant growth rate. Under constant growth rate, the company is paying dividend at a fixed rate, which is growing every year. For example, a company is paying dividend at rupees 10, and it is increasing by 10% every year. For first year, it increased by 10%. For second year, also it is 10%. For third year, also it is 10%. So it is growing at a constant rate, means 10% every year. In the first situation, we have considered the dividend is fixed every year. And in the second situation, we are considering that the company is paying dividend at an increasing rate, but that rate is fixed every year. So how it is calculated? It is calculated, the formula is given that d1 upon ke minus g, or d0 into 1 plus g upon ke minus g. And this constant growth rate is also an unrealistic assumption, because it is not that the companies pay at a fixed rate, or company pay dividend at a rate which is a fixed rate which is increasing every year. Generally, the company pays dividend at a different rate every year. So this is also an unrealistic assumption, that is constant growth rate model. Let us take a practical example on this also. This is constant growth rate. Constant growth rate. Let us take an example. Dividend is 15%. Dividend is 15%. Face value is 100. And growth rate is 5%. And KE, cost of equity or discount rate, is 20%. Dividend is 15%, face value is 100, growth rate is 5%, and KE, that is cost of equity or the discount rate, is 20%. We apply the formula. E0 is equal to D1 upon K minus G. It can also be written as D0 into 1 plus G upon K minus G. Right? So let us put the figures into the formula. Dividend is calculated on the face value. Face value is 100. Dividend is 15%. So it will be 15 rupees. Dividend, it is a current dividend, so it has to be multiplied by the growth rate. 1 plus 105, growth rate is 5%. KE, cost of equity capital, it is given 20%. Less G, growth rate is 5%. So let us calculate it. 15 into 1.05. Let us calculate it. This comes to 15.75 0.2 minus 0.05, it is 0.15. 15.75 divided by 0.15. It's coming to 105. It's coming to 105. I'm hoping you are also getting the same answer. Okay, constant growth rate dividend. Any question on this? So shall we move forward? Okay. Fine. Now, see the variable growth rate in dividend. This variable growth in dividend is more or less a practical approach. Under this approach, it is assumed that the dividend will grow at a particularly high growth rate for a certain number of years. Then it will reduce to a certain rate and it will continue for some time to come. In variable growth rate, there are two, you can say, models. 2-stage model and a 3-stage model. We will try to explain both these models and take practical questions also. Now come to the 2-stage model. Under 2-stage model, it is generally assumed that the company is paying higher growth rate or extraordinary dividend, or dividend is growing at an extraordinary rate for a certain number of years, say 5 years, and after 5 years it will normalize and it is growing at you can say a fixed rate which will continue for infinite or for a long time to come. In this case, it is very important to understand, student, that at certain stages it is very important to assume that the dividend will continue at a certain rate which is sustainable for a long time to come, or which will continue for an infinite period. Otherwise, the dividend discount model will not satisfy. So, 2-stage discount model is more practical, in which it is assumed that the dividend will grow at a high rate for a certain number of years, then it will come down, normalize, and that growth rate would continue for a long time to come. For example, it is assumed that for first 10 years or for first 5 years, the dividend will grow at 10%. Then it will normalize and grow at 5% till infinity. So, let us take a practical example on this. And I will take a practical example, and I will also try to use a simplified approach on how to solve this 2-stage discount model questions. And I will also solve on the basis of the formula which is given in the study material as well as in the PPTs. So let us take a practical question first. I'll just stop sharing it. So this is a 2-stage discount model. Fine. Let us take a practical example. Dividend is ₹2. Growth rate for first 3 years is 10%. Then 5% till infinity. and KE is, the cost of equity is 15%. So, students, we are taking a two-stage discount model. I have taken a practical question, that is, for example, the dividend is ₹2. Growth rate for first 3 years is 10%. Then the growth rate will come down and it will grow at 5% till infinity or for a very long period. And KE, that is cost of equity or the discount rate, is 15%. In this question, how we will approach? We will first calculate the discount present value of dividend at 10%, that is higher rate, and then we will calculate the present value at 5% because there are two growth rates. Now let us calculate the present value of dividend at 10%. That is the high growth rate. Here, dividend present value factor now for 3 years we will be calculating because dividend is going at the rate of 10% for first 3 years. So first year, second year and third year. Dividend for first year is at the end of the first year will be, this is the current dividend, ₹2. ₹2 into growth rate, that is 10% into 1.1. So 2 into 1.1, it will be 2.2. Then in second year, dividend of first year multiplied by the growth rate at 10%. So 2.2 into 1.1, it will come to 2.42. And for the third year, dividend of second year 2.42 multiplied by 10%, that is into 1.1. 2.42 into 1.1, it will be 2.66. And then we apply the present value factor, that is the discount rate is 15%. Present value factor is, for first year is 0.870, for second year it is 0.756, and the third year it is for 0.658. We multiply it by the present value factor, that is 2.2 into 0.87. Let us calculate it. 2.2 into 0.87, that is 1.914. Then second year 2.42 multiplied by 0.756 is 1.83, you can say. And third year 2.66 multiplied by 0.658 is 1.75. Let us add this, all of these. 1.914 plus 1.83 plus 1.75. 5.494. So this is actually the present value at, let's say, 10% growth rate. At 10% growth rate. Now we will calculate the present value at the 5% growth rate. Now pay attention from fourth year onwards, because from fourth year the growth rate is changing at 5%. It is P3 is equal to D3 into 1 plus G divided by K minus G. Now you may ask that why this P3 is taken and not P4, because confusion may arise that dividend is growing from the fourth year onwards. The answer is that P3 is the present value at the end of the third year or at the beginning of the fourth year. Because if you see, if you observe closely that P0, what is the P0? P0 is the price at the beginning of the first year. P0 is the price at beginning of the first year. So P1 will be the price at the beginning of the second year. P2 will be the price at the beginning of the third year. In the same way, P3 will be the price at the beginning of the fourth year. Price at the beginning of the fourth year or the value at the beginning of the fourth year will be dividend of third year multiplied by the growth rate. So it will be dividend at the end of the fourth year. This is the price at the beginning of the fourth year is equal to this present value of dividend at the received at the end of the fourth year. So dividend at the third year we have calculated 2.66. So it will be 2.66 multiplied by the growth rate. Mind you, the growth rate is now changed. It is not 10%. It is now 5% from fourth year onwards. So it will be 0.05 divided by KE minus G. Discounting factor is 15% minus growth rate 0.05. So let us calculate it. Is 2.793 divided by 0.10. 2.793 divided by 10. 0.1. 27.93. So it is actually coming 27.93. 2.793 divided by 0.0. So 27.93 is the present value of dividend at the beginning of the fourth year. But we have to calculate the present value at the beginning of the first year. So let us calculate the P0 at 10% growth rate. So it will be 27.93 multiplied by the present value factor of the third year, 0.658. So it is 18.3. So now we have calculated the present value at 10% discount rate. We have calculated the present value at, this is 5% discount rate. We have calculated the present value at 10% discount rate. We have calculated the present value at 5% discount rate. Then total present value will be arrived at by adding those. The present value at 10% plus the present value at 5%. So now the present value is 5.494 plus 18.38. So it will be 23.88. Present value is 23.88. So how we have proceed? This is a two-stage discount model question. Dividend is ₹2 and growth rate is high, 10% for first 3 years. After that, it will settle at 5% till infinity. Discount rate is 15%. How we have approached the question? We first calculate the present value at 10% discount rate. Then we calculate the present value at 5% discount rate, and then we added both these values. So how this present value at 5% is 10% is calculated? We have taken the dividend at the end of all the 3 years, multiplied it by the present value factor. We arrived at the present value, added all the present value of first 3 years. So present value at 10% is arrived at 10% growth rate is arrived at 5.494. But and then we calculated the present value at 5% growth rate. Here, the formula we applied is P3 is equal to D3 into 1 plus G upon K minus G. Why P3? Because this is the price at the beginning of the fourth year. Mind you, for first 3 years we have calculated. So P3 or the present value at the beginning of the fourth year will be dividend at the end of the fourth year. So dividend at the end of the fourth year, how it is calculated? Dividend at the end of the third year is multiplied by the growth rate, and then we discounted it to arrive at the present value of the beginning of the fourth year. So 2.66 is the dividend at the end of the third year. We multiplied it by the growth rate at 5%, and the present value which arrived at is 27.93, which is the present value at the beginning of the fourth year. But we have to calculate the present value at the beginning of first year. So it is calculated by 27.93 multiplied by the present value factor of the third year. So present value at the beginning of first year at 5% growth rate is 18.38. Now we add the present value arrived at 10% and the present value arrived at 5%, which is 18.38. So present value at 10%, 5.494 plus present value at 5%, 18.38. So total present value is, actual present value is 23.88. Okay, there is one query that Sethu is asking, that in the formula why G is deducted from K. What is the logic behind it? Actually, Sethu, what happened is that K is deducted from K because it is the basic assumption of the Gordon's model. In the Gordon's model, it is assumed that the K, that is the cost of equity or the minimum required rate of return, is always higher than the growth rate. Is always higher than the growth rate in dividend. And practically it happens also. If this situation does not happen, the dividend discount model will not be applied. Some other model will be applied. So this is actually the basic assumption of the Gordon's models, that the K, that is the cost of equity or the minimum required rate of return, will always be higher than the growth rate in dividend. That is why the formula is K minus G. Okay. So now let us get back to the PPTs again. Now, this two-stage dividend discount model can be solved with the help of this formula also. You may find it, actually, the method which I have just used is more, you can say, user-friendly. But I will calculate this with the help of this formula also, so that you can have a grasp of that how it is calculated with the help of the Gordon's formula. So let us calculate by this method what has been given in your study material. I will stop sharing it. I'm now just rubbing it, and of course I have to use a different method now. Now the formula is actually two-stage model. E0 is equal to D0 into 1 plus G upon 1 plus K plus D0 into 1 plus G square upon 1 plus K. This is for the second year. And in this question, 10% for first 3 years. So we'll take the figures of first 3 years. D0 into 1 plus G upon 1 plus K 3 plus Pn upon 1 plus K. Pn, or Pn is actually the end of the super growth rate period or the beginning of a normal growth rate period. So beginning of the normal growth rate period is fourth year, because for first 3 years the dividend has been growing exponentially at a higher rate of 10%. But from the fourth year onwards, the dividend growth rate is more or less stable at about 5%. So we will take PN as P3. That is why P3? P3 is the end of the super growth rate period. That is at the end of the third year or the beginning of the fourth year. Upon 1 plus KE. Just give me a second. So will be 1 plus K3. Okay. Now how this P3 is calculated? P3 is calculated by D0, 1 plus G, G1 and 1 plus G2 upon so D0 into 1 plus G1, that is the growth rate which is at 10%, and G2 which is growth rate at 5%. Okay. Now let us solve this question, the example which I have given to you on the basis of this formula. Dividend is actually, it was 2 into 1 plus G growth rate 0.10 upon 1 plus K. The discount rate which we have assumed is 15%. Second year it will be 2 into 1 plus 0.10. So first of all, we calculate this portion. Okay, this portion. The growth rate at 10% for first 3 years. So let us calculate this. 2 into 1.1, that is 2.2 divided by 1.15 plus, that is 1.1 square into 2, it will be 2.42 upon 1.15 square plus, it will be 1.1 into 1.1 into 1.1 into 2. So it will come to 2.66 divided by 1.15 square. So let us calculate this. It will be 1.913 plus this figure, it is 1.83 plus 1.752, that is this figure. We add all these figures. $1.913 plus 1.83 plus 1.752 is coming to 5.495. So 5.495 is the present value at this 10% growth rate. This portion actually. And now we calculate the P3, the value of P3. So P3 is equal to, we put the values into the formula, D0 to 1 plus G1. G1 is the higher growth rate for first 3 years, 0.1, 3, 1 plus G2. G2 is the normal growth rate period, 5%. divided by Ke minus G2, that is 0.15 minus 0.05. So 2 into 1.13 is actually the 2.66. So 2.66 multiplied by 1.05, 2.66 multiplied by the 1.05 upon 0.01. Let us calculate this. 1.1 into 1.1 into 1.1 into 1.1 multiplied by 2, it is coming to 2.66 multiplied by 1.05 divided by 0.15 minus 0.05, it is 0.1. So let us calculate this. It's 27.93. It's 27.93. So again, we have calculated this portion. We have calculated the portion of P3 also. So let us calculate the total present value. P0 is equal to P0. We have calculated this portion. It comes to about 5.495. So 5.495 plus P3 27.93 divided by 1 plus KE. So 1 plus the discounting factor is 15%, 0.15 cube is equal to, let us calculate it, 5.495 plus, let us calculate this figure, 1.15 cube, 27.93 divided by 1.15 cube, it's coming to 18.38. 18.38. So we add this 5.495, that is present value at 10% growth rate, plus 18.38, which is the present value at 5% growth rate. So it is basically 5.495 plus 18.38, coming to 23.88. So we see that by both this method, the first method and by this method, by applying this formula, the answer is present value is 23.88. The answer in both the cases is same. How we have approached this question? Formula is this: D0 into 1 plus G1, 1 plus KE. Up to this portion, this is for, we will calculate the present value at 10%. And then P3 upon 1 plus KE. P3, the formula is P3 is this. We put the values in the formula. Dividend is 2 and the growth rate for first 3 years 10% divided by 1 plus 0.5. It is the cost of equity, that is a discount rate. We take it for first 3 years because the dividend is growing at 10% for the first 3 years. We calculate this value for the first 3 years, which is 5.495. So it is 5.495 is the present value at 10% growth rate. Then we calculate this portion, P3 upon 1 plus K3. We will first calculate P3 by applying this formula. So dividend is rupees 2. We multiplied it by 1 plus 0.1, that is G1. G1 is the exponential growth rate or extraordinary growth rate, which is 0.10 cube. Then multiplied by 1 plus G2. G2 is the growth rate of second growth rate, that is at 5%. Then so 1 plus 0.05 divided by K minus G2. K is 15% minus G2, or the second growth rate is 5%. That is why 0.15 minus 0.04. Just give me a second. P3 has been calculated by applying this formula. We calculated 27.93. 27.93 is the P3, that is present value at the start of the fourth year. Now we have to calculate the present value at the start of the first year. So this will be calculated. P0 is equal to this figure. From this to this we have calculated, which is 5.495. Therefore 5.495 plus this portion, P3 upon 1 plus KE cube. P3 we have calculated 27.93 upon 1 plus 0.15, which is KE, the discount rate cube. So we have calculated it 5.495 plus this portion is 18.38. So 5.495 plus 18.38, which is 23.88, which is the present value for this two-stage discount model question. So I hope it is clear. You can calculate by both this method, the first method which I have discussed and also the second method. First method is more or less user-friendly, it is easy, but you can calculate it by second method also, and I would recommend that you practice both these methods, and whichever suits to you can apply that. So this question you should practice at home after this lecture. Please practice this question by both these methods, because I will take one question on this two-stage discount model in the assignment also. Okay, any query on this? Otherwise, I will move forward. Let us share me the PPTs first. Fine. Just give me a second, please. Fine. Now come to the so this is the formula. I will repeat it, Simon, don't worry. Just go through it. This is the formula. According to this formula, I have calculated this. And this is D0 is the dividend just paid, as you know, the current dividend. G1 is the super growth rate period. In this example, it is the 10%. G1 is the super growth rate period, 10% in this example. G2 is the normal growth rate, that is 5%. And K is the required rate of return on equity or cost of equity or the discount rate. And PN is the price of share at the end of the super growth rate period. In this case, in this question, the super growth rate period ends at the third year. So PN will be actually, it will be written as P3, that is at the end of the third year or at the end of or at the beginning of the fourth year. Okay, Sairam, and for your convenience of the other students, I will just repeat this, whatever I did it according to the formula in this question. Yes. So the question was the discount rate, and for 10%, the company will be paying 10% dividend for the first 3 years, high growth rate. Then dividend will be paid at about 5% for the next few years, that is till infinity. And growth rate is 10% for the first 3 years, then 5%. Dividend is ₹2, and the discount rate is 15%. Now, how we have proceeded it? According to this formula, we have proceeded like this. First, we calculate the present value for the first 3 years according to this formula. So what is the dividend? D0 is the current dividend. 2 multiplied by 1 plus 0.10. What is 0.10? 0.10 is the growth rate for the first 3 years. For first year, the growth rate is 10%. Therefore, we have taken 1 plus 0.10 divided by 1 plus 0.15. 0.15 is the discount rate. Okay. Now for second year, the same discount rate is 0.15 and the growth rate is 10. For third year also, the growth rate is 10% and the discount rate is 15. Now we added all these figures for first year, second year, third year. We calculated the present value, that is value at the beginning of the first year, which is 5.495. So this is 5.495 is the present value for first 3 years at the 10% growth rate, the extraordinary growth rate. Now the growth rate changes from the fourth year. It is now not 10%, it is actually 5%. So we calculate the P3. What is P3? P3 is actually the start of the normal growth rate period or end of the super growth rate period. Super growth rate period is at 10% for first 3 years. So normal growth rate period is from the beginning of the fourth year. So that is why P3, that is at the end of the third year or at the beginning of the fourth year. So P3 is D0 into 1 plus G1. G1 is the growth rate, extraordinary growth rate 10% Q. G2 is the normal growth rate, which is 5% in this question, and K is the cost of equity, which is 15%, and G2 is the normal growth rate, 5%. We apply the formula to D0 into 0.10, 10%, that is the super growth rate, Q, 1 plus 0.05, this is the G2, normal growth rate, K minus G2, K is 15%, minus G2, G2 is the normal growth rate period. Okay. So P3 is calculated as 27.93. This P3 has been 27.93. Now we again apply the formula. We have to calculate this present value at the beginning of the first year. It is actually the present value at the beginning of the fourth year. So we have to calculate present value at the beginning of the first year. So we apply this formula. This portion we have calculated, which is 5.495. So 5.495 plus, now we apply this formula, P3 upon 1 plus KE Q. What is P3? P3 is 27.93. 27.93 divided by 1 plus 0.15. 0.15 is the 15%, which is the cost of capital of the minimum required rate of return. It is 1 plus 0.15 Q. So it comes to, if you calculate it, it will come to 18.38. So 5.495 plus 18.38, it is actually 23.88, which is the present value, total present value, by considering both the growth rate at 10% growth rate and the 5% growth rate. 23.88 is the answer. So by applying this formula, also you can calculate this. I hope it is now clear to you. So you practice this question at home. We will, don't worry, we will do one question on the assignment also on this 2-stage discount model. But please practice it after this lecture by both the methods actually. So next is about 3-stage discount model. Now before moving on to this 3-stage discount model, let us take a brief break of about 10 minutes. It is now 8:35, so let us meet at about 8:45 and be ready for queries also. If any queries you can ask in that period. So let us take a break of about 10 minutes and meet at about 8:45. Okay, so we have discussed the 2-stage discount model under the variable growth rate. Because in the corporate model, there are three stages. That is zero growth rate. We have seen zero growth rate means the company is paying dividend at a fixed rate, for example, 5% every year. And second, we have assumed taken is constant growth rate, that in which the company is paying dividend at a growth rate which is actually constant, which is fixed. For example, 10% increase every year. And then we come the variable growth rate model, means company is paying dividend certain number of percentage for first few years, then it changes the dividend. So there are two methods under the variable growth rate, that is two-stage model and a three-stage model. Under the two-stage model, it is for certain number of years, initial years, for first 5 years, 6 years, 7 years, the growth rate is taken at a very high rate, extraordinary rate, for example, 10%. Thereafter, the growth rate changes to about 5% or so. And it will continue for till infinity. Now we come to the three-stage discount model, and this three-stage discount model is also a very practical approach. 3 stages are taken. In the first stage, it is assumed that the dividend the company will be paying at a very extraordinarily high rate, for example, 15%. Then comes the transition period, which is the second stage. Transition period means dividend growth rate will be declined by a certain percentage every year. For example, 3% for every year. Then after 3 years, it will be settled. The growth rate will be settled, and it will increase at a normal growth rate for till infinity. This will be the third stage. For example, 5%. So for first few years, it will be increased at extraordinarily high growth rate. For example, 15%. Then comes the transition period. That is, dividend will decline at a certain decline by a certain percentage every year. For example, first 3 years or 4 years. Then it will settle at a discount rate, at a fixed discount rate, which will continue till infinity. This is also called the H model. Okay, this three-stage model. Now, the formula for this three-stage model is, it is written in front of you, D0 into 1 plus Gn. What is Gn? Gn is the normal growth rate period. For example, 5% in this case. Upon RE minus Gn. RE is nothing but KE, that is the cost of equity, the discount factor, which is RE. Gn, the normal growth rate, 5% in this example. Now D0 is the current dividend, present dividend. What is H1? H1 is the half of the transition growth period. It is given. H1 is equal to half of the duration of the transition growth period. In this example, what is the transition growth period? The transition growth period is 3 years, because we have assumed for the next 3 years, the dividend growth rate will decrease at 3% for the next 3 years. So if the 3 years is the transition growth period, then half of 3 years will be 1.5. So this H1 will be 1.5. And GC is the extraordinary high growth rate, for example, 15% in this case. Now this is the formula. This is the explanation. Gn is the normal growth rate in long run. GC is the current growth rate, initial short-term extraordinary growth rate, and H1 is the half of the duration of the transition growth period. So we have seen the formula. I have explained the terms. Let us take a practical question in which this three-stage model will be more clear to you. Stop sharing it. Okay. So now let us move forward. And you have got the formula. And now let us take a practical example. Dividend is 2.5. K is 10%. Dividend grows at 18% for first 4 years, then declined by 3% for next 3 years. Okay, dividend is 2.5, KE or cost of equity is 10%. Dividend grows at 18% extraordinary growth rate. This is the first stage for first 4 years. Then declined by 3% for next 3 years. This is the second stage of the transition growth period. Declined by 3% for next 3 years. Then stabilized at 8% till infinity. Stabilized at 10% till infinity. So this is the question. Dividend is 2.5, KE is 10%, dividend grows at 18% for first 4 years, extraordinary growth rate. Then comes the second stage, the transition period, in which the dividend is declining by 3% for next 3 years. Then it is stabilized, normal growth rate period at 8% and will continue till infinity. Now apply the formula. E0 is equal to D0 into 1 plus Gn divided by R minus Gn plus D0 H1 GC minus Gn divided by R minus Gn. So this is the formula. P0, present value of equity shares. D0 is the current dividend. Gn is the normal growth rate period, which is actually 8% in this case. 8% is the Gn. And R is the cost of equity, which is given 10%. And what is H1? H1 is the half of the duration of transition growth period. What is the transition growth period? Duration of transition growth period, second stage is 3 years. So half of 3 is 1.5. So H1 will be 1.5. And what is GC? GC is the extraordinary high growth rate. That is 18%, which is for the first 3 years. Extraordinary high growth rate, 18%. This is the normal growth rate, 18%. And this is the transition period, 3 years. Duration of the transition period. So this transition period, half of this transition period is 1.5. Now let us put the figures into this formula. Excuse me. Okay, dividend is 2.5. 1 plus normal growth rate period is 8% divided by R, which is the cost of equity, 10%, minus normal growth rate period, which is 8%, plus D0, current dividend, 2.5, multiplied by H1, half of the transition growth rate period. Transition growth rate period is 3 years, half of 3 is 1.5. 1.5 multiplied by GC. GC is the extraordinary growth rate, which is 18%, minus normal growth rate, which is 8%, divided by R minus Gn. R is the cost of equity, which is 10%, minus Gn, normal growth rate period. 100, which is 8%. Now let us try to solve this. It is 2.5 into 1.5 multiplied by 0.1. So it is actually 0.375 divided by 0.02. So 0.02, 2.7 plus 0.375, 3.075. So 3.075 divided by 0.02 is 153.75. 153.75 is the present value of equity as per the 3-stage discount model. I hope it is now clear to you how we have approached this. I will repeat it again, the 3-stage discount model. Under the 3-stage discount model, there are 3 stages. In the first stage, it is assumed that the dividend is growing at a very fast rate, extraordinarily high rate. In this example, it is assumed at 18%. Then comes the second stage, which is the transition period, in which the growth rate declines at a certain percentage. In this example, it is 3% for next 3 years. And then comes the third stage, in which the growth rate is stabilized at a certain percentage, which is 8% in this particular case. This is the formula. Present dividend is 2.5 and the cost of equity capital is 10%. This is the formula. We applied this formula. We put the values into the formula and we have calculated it. This formula. The answer is coming to 153.75. So, even also any aspect which you are not understanding, you can please ask. Three-stage discount model. So I hope it is clear to you. Okay, fine. Shall I proceed now? So let us get back to the PPTs again. It is not 27, Sairam. Actually, it is 2.7 upon 0.02. Just check at your end. It is not 27 actually. It is coming to 2.7 upon 0.02. So it will be 153.75. So again, please check at your end. And then 2.7 will be added to 0.375. You have to apply the whole formula. 2.7 plus 0.375 divided by 0.02. So it is coming to 153.75. So the sign, please check at your end. Fine. Any question before proceeding to earning based model? Fine. So, in the earning based model, the dividend discount model is not applied. Earning based model is applied when the investor is willing to forego his cash dividend, or when the investor is actually investing in a growth oriented company in which the company is foregoing cash dividend and employing the retained earnings into profitable growth opportunities. So in such cases, the investor is willing to forego the cash dividend, and therefore the earning based model is applied instead of the dividend based model. Earning based model, there are three different approaches: Gordon's approach, second is Walter's approach, and the third approach is price earning ratio or multiplier approach. We will take all these three approaches. Let us take the Gordon's model first. Actually, Gordon's model, on earning based model, there are two broad assumptions. First is return on retained earnings remain the same, because this model assumes that the company is not paying dividend or paying dividend at less rate and employing the profit, that is the profit which is retained earnings in investment opportunities. So first assumption is return on those retained earnings remains the same, and retention ratio remains the same. It's whatever the company is retaining and not paying dividend. Now the formula for this earning based model, Gordon's approach, is EPS 1 into 1 minus B upon KE minus BR. So what is B? B is a retention ratio, whatever company is retaining. For example, company is paying dividend at 40%. So what is the retention ratio? 60%. And KE minus BR, KE you know, cost of equity, and EPS 1 is the EPS at the end of the first year. And BR, what is BR? B you know is the retention rate, and R is the return on retained earnings. So when return on retained earnings R is multiplied by the retention ratio, it is actually, so BR is actually the growth rate. We will do some practical problems on this also. Let us first understand this earning based model of the Gordon. Okay, so what was the formula? Gordon's approach of earning based model. The formula is actually P0. P0 is equal to EPS 1 minus B upon KE minus BR. So let us take an example. EPS is 10, KE is 20%, and there is 100% dividend payout. 100% payout. Let us see. 100%. I will take both the situation, 100 payout and 60% payout, dividend payout. So this is the example. EPS is 10, the cost of equity is 20%, and there is 100% dividend payout. Now we will apply this formula. P0 is equal to EPS. What is the EPS? EPS is given in the question, 10 multiplied by 1 minus B. What is B? B is the retention ratio. B is the retention ratio. So 1 minus B. What is retention ratio is? Retention ratio is 0 because there is 100% dividend payout. So retention B is 0 divided by KE. What is the discount factor? The discount factor is 20%. Minus B into R. Retention ratio is 0. So if it is 0, then there will be no return. So it is Actually, BR is 0. So 10 upon 0.2. It is coming to rupees 50. So present value, earning based model, this example it is 50. Now just change this example. EPS is 10, same. EPS is 10, K is 20%, and the dividend payout is B is 40%. B is 40%. That is, retention is 40%. It means the company is paying dividend at 60%. And the return on retained earnings means whatever amount is being reinvested, that is the 40% amount which is being invested in profitable growth opportunity, the return is actually 25%. So this R is the return on retained earnings. Now apply this formula again. EPS 10, 1 minus B, retention ratio 40%, upon KE minus BR, KE 25%, minus BR, retention ratio is 0.5, 0.4, 0.4 into return on retained earnings is 0.25. R is 0.25. Let us calculate it. So 10 multiplied by 0.6 is coming to 6 upon 0.4 into 0.25, 0.1 to 0.25 minus 0.1. 0.15, 6 upon 0.15, no, K is actually 20%, no? 20. 0.4 into 6 upon 0.1. So 6 upon 0.1 will come to 60. So this is rupees 60. So as per earning based model, you can see that if the retention ratio is increased, then the market price or the present value equity share also increases. Because in the first case, we have taken that company is paying dividend at 100%, 100% dividend payout, zero retention. In that case, the present value comes to rupees 15. And in the second case, we see that the company is retaining 40%, means it is paying at 60%. If the company is retaining 40% and it is employing in investment opportunities, it is getting return at 25%. Okay. In such case, the present value comes to 60. So present value increases when the company is retaining more and paying less dividend. This is what the Gordon's approach of the earning based model. Fine. Now let us get back to the PPTs again. Now come to this Walter's approach. Walter's approach, it is same as Gordon's approach. It says that in case of growth-oriented companies, where there are profitable opportunities on the part of the companies, as the company retain more and invest in various profitable growth opportunities, the company's present value increases. And in case of non-growth oriented companies, means companies which are at a maturity stage, does not have many profitable investment opportunities. In case of such companies, the the growth rate is generally less, you can say. So, or in such cases, if the company pays less dividend, then the present value is generally more. The growth rate is more. So, Walter's approach says that growth-oriented companies, if the company pay less dividend, then present value will be more. And in case of non-growth companies, where the company paying less dividend, then the market price will be more. Or in case of non-growth companies, as the company pays higher dividend, the market price will be more. So this formula is D plus E minus D into R upon K upon K. So as per Walter's approach, I will take some time to explain this. Let's go to the Excel sheet. So as per this Walter's approach, if R is greater than KE, R is greater than KE, it means what is R? R is return on retained earnings, means whatever company is retaining, and KE is the cost of capital. So if R is greater than KE, it means it is a cost of capital company is paying dividend, growth oriented company. Oriented. So higher retention, higher present value. Okay. In the second case, if KE is greater than R, that is, if the cost of equity in the form of dividend is greater than the return on retained earnings, then it is a mature company. Higher dividend payout, higher present value. Okay. So this is what is the Walter's approach is all about. Now I will stop sharing it. I will again go to the PPTs. Okay. So I hope this Walter approach is clear to you now. I will want to tackle question the assignment in which both the Gordon approach and the Walter's approach will be taken. Now come to price earning ratio, the multiplier approach. This is one of the most common valuation approaches, since price earning ratio is based on the ratio of share price and the EPS. And this is very simple to calculate. That is, the value is EPS into price earning ratio. So I will take one simple example in which it will be more clear to you. Let us go to the Excel sheet itself. Let's try to understand this. So basically, what is price earning ratio? Price earning ratio is equal to market price per share divided by earning per share. Market price per share upon earning per share. And value will be calculated as value is equal to P multiplied by EPS. Okay. So if the market price is if the EPS is 10 and the price earning ratio is 25, price earning ratio is 25 say, and EPS is 10, then the value will be 250. But the problem in price earning multiple or earning based approach is that how to estimate this price earning ratio and the EPS, because both these figures are estimated. EPS you can estimate by the, you can say EPS figures on the basis of EPS figures of last 5 years or on the basis of EPS figures of last 10 years. But what about price earning ratio? Price earning ratio is estimated on the basis of the price earning ratio of similar companies in the same industries. For example, in case of IT companies, if you want to calculate this value of Infosys on the basis of price earning multiple, you can see the price earning multiple of other companies in the IT sector such as TCS, HCL, Wipro, and on that basis you can estimate a price earning figure. So this way the price earning ratio can be estimated. But again, the price earning, on the basis of price earning ratio, cannot judge that whether a company is good or bad. On the basis of price earning ratio, you can only tell that whether a company's stock is cheaper or it is costlier. So again, I will come back to the PPTs. Thank you. Any question till now? Otherwise, I will move to the next very important topic, that is cash flow based models. Okay, fine. So in the cash flow based model, it is a more practical approach because in dividend based model, the future cash flows are only taken as dividend. And when earning based model is taken when the company is not paying dividend regularly or growth oriented companies. But cash flow based approach is more practical because there are other things also besides dividend. There are two approaches in this cash flow based model, that is free cash flow to firm model, that is FCFF, and free cash flow to equity model. So FCFF is free cash flow to firm and FCFE is free cash flow to equity. So I will stop sharing here and just clarify your concept in this FCFF and FCFE. Now first is free cash flow to firm. Free cash flow to firm, that is FCFF. Free cash flow to firm. So this is also called as a unlevered. This is also called as unlevered cash flow. What is called the unlevered cash flow? It is called the unlevered cash flow because it is the cash flow which is available to both the debt and the equity holders. That is cash flow available to both debt and equity holders. That is what is called the unlevered cash flow. How it is calculated? How the present this cash flow is calculated? This cash flow is calculated by, first we take the non-operating profit after tax. It is non-operating profit after tax. Short form is NOPAT. Plus interest expense. Interest 1 minus T. T is the tax. Interest is added because because we are taking the cash flow, unlevered cash flow. So interest have to be added back, plus depreciation minus any capital expenditure minus any change in working capital. So this way the free cash flow is actually calculated. That is non-profit after tax plus interest. Interest is added back because the debt and equity are not yet been considered. It is the cash flow is before paying anything to debt and equity holder. That is why interest expenses are added. Depreciation is a cost, non-cash item, it will be added. Any capital expenditure, any change in working capital means whatever expenditure on working capital is deducted, any capital expenditure is deducted. That is the cash flow to the firm. It can be calculated on the basis of cash flow from operations also. You can direct take cash flow from operating activities and you add the depreciation plus interest. No, depreciation has been considered in the working capital. So simply you take the interest minus any capital expenditure. Okay. Now come to free cash flow to equity. Free cash flow to equity, which is also called FCFE. And it is the levered cash flow. It is a levered cash flow. Why? Because the cash flow which is available after adjusting the debt. It is available only to the equity shareholders now. Since the debt is adjusted, we will take the figures of debt also. So how it is calculated? It is net operating profit after tax, that is no PAT, plus interest in this case interest will not be taken because the debt has been fully adjusted. So depreciation will be added back, less any capital expenditure, that is capex, less any change in the working capital, plus new debt issued minus debt repaid. Since it is the cash flow which is available to the equity shareholder, therefore the adjustment regarding debt should be made. Or it can be calculated from the basis of cash flow statement also, that is cash flow from operations, cash flow from operating activities, minus capex, minus change in working capital, plus debt paid and plus any debt issued, new debt issued. So this is basically the concept of free cash flow to firm and the free cash flow to equity. This is the most practical approach, and finally the present value of this cash flow is taken into account. Most of the companies actually follow this free cash flow to firm and free cash flow to equity method. While valuing equity shares, this free cash flow to equity is taken into account. So in free cash flow to equity, that cash flow is taken which is available, which is freely available after deducting the working capital expenses after deducting any debt. So whatever amount remains which is available to the equity shareholders, the cash which is available to the equity shareholders, the present value of that figure is actually taken. So it is more a practical approach while calculating present value of equity shares. That is free cash flow to equity. Any question on this free cash flow to equity? Okay. So we shall proceed further. And now come to the another very important factor, which is enterprise value. So what is enterprise value? Enterprise value is the true economic value of a company. It is also called the takeover price, or the price at which one particular company acquires another company, or purchases another company. So in this case, the enterprise value is market capitalization plus long-term debt plus minority interest less any cash and cash equivalents. So enterprise value is the takeover price, or it is the price which one company acquires another company. Generally, if the enterprise value is higher, it can be said that the particular company is, you can say, overvalued, or a particular company is costly. And if the enterprise value is less, it can be said that the company is undervalued, the company is relatively cheap to acquire. Now, before moving to this enterprise value to sales, one item which is okay, if you have any question on this, I shall happy to answer that. Otherwise, I will move. One thing which is coming to mind, that minority interest. What is this minority interest, and why minority interest is added to the enterprise value? The reason is that in case of the holding companies and subsidiary companies, in the consolidated balance sheet of holding companies, the earning before interest and tax and depreciation amortization, that is EBITDA, the entire profit is shown in case of subsidiary companies, even if the holding company is not holding the 100% shares in its subsidiary company. For example, I will give you a brief example to let you understand the concept of minority interest. Because question may arise in your mind that why minority interest is added. Okay, market capitalization and debt is added because when one company is acquiring another company, total market capitalization taken, debt is also taken, because if company A is acquiring company B, it is also taking the debt of company B. Cash and cash equivalents are obviously, you can say, deducted, because when company A is acquiring company B will be paying this in cash. So therefore, the cash and cash equivalents are deducted. But what about minority interest? Let us say company A is planning to acquire company B, which has a subsidiary X, in which it is holding about 60%, holding 60% shares. But in the consolidated balance sheet of company B, the EBIT figure, the EBIT, EBITDA, you can see, earning before interest and tax, depreciation, amortization, shown the 100% profit figure. In the profit and loss account, the consolidated balance sheet of B will show the 100% profit of the subsidiary of company B, that is X. But if while calculating enterprise value, only 60% has been taken, so this creates an anomaly. So the rest of the 40% value should also be taken in order to have a comparable figure with this earning before interest and tax. So this minority interest is taken into account. What is this minority interest? Minority interest is the value of the subsidiary company which is not held by the holding company. So minority interest is 40% in this case, because B, a holding company is holding 60% shares in its subsidiary, which is X. So 40%, which is not holding, is the minority interest. And this minority interest has been included because in the consolidated balance sheet of the acquiring company, the profitability figure shows the 100% value. So while calculating enterprise value or the takeover value or the acquisition price, this the 60% value will not be added, the entire 100% will be added. So this 40% minority interest, which is not held by the company B in its subsidiary X, will be added to the enterprise value. That is why minority interest is added to enterprise value. So enterprise value is market capitalization plus total debt plus minority interest less cash and cash equivalent. Now comes to the PPT again. The next ratio in relation to this enterprise value is enterprise value to sales. Enterprise value to sales is a measure an acquiring company generally have in terms of its sales. So a higher ratio indicates that a company has to earn higher sales. If a company acquires another company, it has to achieve higher sales. So that company can be considered as expensive to purchase if the enterprise value is higher in comparison to sales. So it can be considered a expensive. Acquisition cost can be considered as expensive. And if the ratio is low, because ratio is low means enterprise value is higher than sales by not a very high amount, then it can be considered as an undervalued company. And it can be said that a company is cheaper to purchase. And enterprise to sales value is also employed in case of those companies which are having negative free cash flows. Now come to enterprise value to EBITDA figure in earning before interest and tax and depreciation and amortization figure. EBITDA is commonly known as the amount available to both the debt and equity holders of a company. Okay. Now this multiple is generally used for those companies, capital intensive companies, in which there is a huge investment in fixed asset is required. So these companies generally have a very high amount of depreciation, substantial depreciation and amortization expenses. So enterprise value to EBITDA is generally applicable in the case of those companies. Now come to valuation of rights. Rights shares, as you know, rights shares are offered to the existing shareholders of the company at a discounted price. So immediately after the right issue, the price of share is called the X-right price or the theoretical X-right price, which is computed as follows. That is, formula is given in front of you, NP0 plus S upon N plus N1. So this N is basically the number of existing equity shares, N1 is the number of new shares offered by way of right issue, P0 is the price of the share before the right issue, and S is the subscription amount raised from the right issue. And after this calculation of the right issue, and that is calculation of theoretical X-right price, theoretical value of a right is calculated. The formula is X-right price minus subscription price. So I will take a question in which your concept will be clear in this right issue, how to calculate or how to value right shares. So let us go to a particular question on right issue. So this is the question, just go through it. Or you can say, you can screenshot of it or can a snap of it so that you can calculate by me alongside. I will read the question first. ABC Limited shares are currently selling at 13 per share. It means the current market price per share is 13. There are 10 lakh outstanding shares is 10 lakh. and firm is planning to raise 20 lakh to finance a project by way of right issue. Okay. You are required to calculate the X right price of a share and the value of right, both. In the case of first situation, if the firm offers one right share for every 2 share held, and secondly, if the firm offers one right share for every 4 share held, and in both these cases, what will be its effect on the wealth of the shareholders, whether the shareholders' wealth will increase or whether the shareholders' wealth will decrease. So let us solve this problem by applying this formula which I have just given. So I am stop sharing it. I hope you have now noted the question and take a snapshot of this. Okay. Now let us move to the whiteboard for the solution. Okay. Now, let us take the situation number 1 first. What the situation number 1 is saying? Situation number 1 is saying that the firm offers one right share for every 2 share held. Okay. Now, what is the current outstanding shares? The current outstanding shares are 10 lakh. And if the company offers one right for 2 shares, so it means for 10 lakh shares, it will be 5 lakh shares. So, total shares, or let us take the, you can say, total shares are 15 lakh. Number of right shares, is 5 lakh because 10 lakh shares outstanding and ratio is 2:1. One right share for 2 shares held, or therefore for 10 lakh shares it will be 5 lakh. So number of right shares is 5 lakh. And what is the subscription price? What will be the subscription price? The subscription price will be what is the amount which is raised by way of right shares? That is 20 lakh. 20 lakh divided by 5 lakh. So this is the total amount which the company wants to raise by way of right shares, and this is the number of shares which the company wants to issue, 5 lakh. So subscription price or right issue per share is 20 lakh upon 5 lakh is rupees 4. It's rupees 4 per share. Okay. So now calculate the X right price. Now calculate the X right price. X right price, the formula is that is given to you N P0 plus S upon N plus N1. So it will be existing number of shares. Is the existing number of shares are 10 lakh. Existing number of shares 10 lakh into existing price, which is given in the question, which is 13, plus the subscription amount, that is the amount which is raised by way of right issue is 20 lakh, divided by N plus N1. Outstanding shares 10 lakh and shares issued by way of right issue is 5 lakh. So 10 lakh plus 5 lakh. So let us calculate this. 10 lakh into 13, 1 crore 30 lakh plus 20 lakh, it is 1 crore 50 lakh upon 10 lakh plus 5 lakh, 15 lakh. So it is rupees 10. So the X right price is rupees 10. Then we calculate the value of right. Value of right, which is X right price minus subscription price. X right price minus subscription price. X right price we have already calculated, which is 10, minus the subscription price we have calculated. This is the subscription price 4. So 10 minus 4 is equal to 6. So 6 rupees is the answer in case of first situation. So how we have calculated? First we calculate the X right price, then we have calculated the value of right. How X right price is calculated? We take the NP0, the total amount before the right issue, that is 1 crore 30 lakh, means 10 lakh into 13. 10 lakh is the outstanding shares, and this is the present market price, and the right issue amount is 20 lakh. So it will come to 1 crore 50 lakh divided by the total number of shares, means 1 crore 30 lakh is the existing number of outstanding shares. 13 lakh is the outstanding, 10 lakh is the outstanding number of shares, and plus 5 lakh by way of right issue. So total number of shares after right issue is 15 lakh. So we divided 1 crore 50 lakh by the 15 lakh, which comes to actually 10. And value of right is the X right price, means the right price issue of right shares after the right issue minus the subscription price of the right issue. So X right price we have calculated 10, and the subscription price of right we have calculated here. How it is calculated? The number of right shares is 5 lakh. How we have calculated it? The number of outstanding shares is 10 lakh. And the ratio is, right issue ratio is 2:1, means one right share will be issued for 2 shares held. So for 10 lakh, it will be 5 lakh. So 5 lakh right issue shares, and total subscription price means company wants to finance this project by way of right issue, which is 20 lakh. So total amount 20 lakh divided by the number of right shares, 5 lakh, comes to 4 per share. So this is the subscription price. This is the price at which a subscriber of right issue has to pay. So this X right price means right price after the right issue minus the subscription price of the right issue is actually the value of right. This situation is just 10 minus 4. Now take the second situation in which the ratio is 1:4, means one equity share will be, one right share will be issued for 4 shares held. One right share will be issued for 4 share held. Okay. Now let us calculate it. The number of right share will be total outstanding shares 10 lakh, and 10 lakh divided by 4, it is coming to, it will be 2,50,000. That is 10 lakh divided by 4. So subscription price will be 20 lakh. 20 lakh with the plan, which the company is planning to raise by way of right issue. 20 lakh divided by 2,50,000, which is coming to 20 lakh. It is calculated divided by 2,50,000. It is coming to about 8. So subscription price is 8. Let us calculate X right price. X right price is, what is the existing shares? NP0. It will be same. 1 crore 30 lakh. Okay. 1 crore 30 lakh because 10 lakh outstanding shares into current market price 13. So 10 lakh into 13, 1 crore 30 lakh. Plus the subscription amount, which is 20 lakh, divided by total number of shares. Existing shares 10 lakh plus number of shares issued by a private issue is 2,50,000. So 10 lakh plus 2,50,000. 10 lakh existing shares plus 2,50,000 shares will issued by way of right issue. So it will be 1 crore 50 lakh divided by 12 lakh 50,000. Let us calculate it. 1 crore 50 lakh divided by 12 lakh 50,000. It's coming to 12. So X right price is 12. Now calculate the value of right. Value of right is X right price minus subscription price. X right price we have calculated, and we have also calculated the subscription price. So X right price is 12 and the subscription price is 8. So X right price 12 minus subscription price 8. That is 4. So answer is coming to 4. If the company is offering 1 right share for 4 shares held, and if the company is offering 1 right share for 2 shares held, then the value of right is ₹6. So any question regarding this? Otherwise, I will move forward. That what is its effect on the wealth of the shareholders? Okay, Suresh, we will see to that. Any question on this? Whatever has been solved then on the board? That if the right shares are, the ratio is 1:2:1, and if the ratio is 4:1. So, again. So I will now discuss the wealth on the shareholders. I will rub it on the front. What is its effect on the wealth of the shareholders? Whether the shareholders' wealth increases or the shareholders' wealth decreases if the ratio is 2:1 and if the ratio is 4:1. In the first situation, when the firm or the company offers 1 right share for 2 shares held, so in such cases, the value of share, the total value of share is, it will be 150. Let us say investor is holding 100 shares. So let us assume the case of 100 shares. The investor is holding 100 shares. If an investor is holding 100 shares, then what will be its effect on this wealth if the company is issuing 1 right shares for 2 existing equity shares? These total shares will be 100 plus 50 right shares. So total shares will be 150 multiplied by the subscription amount. The subscription amount in case of the first situation is 10 rupees. We have calculated that. So it is 1,500. This is its value. Less what is the price the shareholder has paid for the right shares. is 50 shares into the subscription price, which is actually the 4 rupees. 50 into 4, that is 200. So it is 1,300. So 1,300 is you can say, the wealth of the shareholder in case of situation 1. How about situation 2? What will be the effect on the wealth of the shareholder if the company issues one right share for 4 existing equity shares? What is total number of shares? 100 existing shares and 25 shares is bought. 125 shares into the subscription amount of the into the X right price. X right price is 12. 125 into 12, that is just calculated. 125 multiplied by 12, it is 1,500. Less the acquisition price, that is he has purchased 25 right shares multiplied by the subscription price of right shares is rupees 8. 25 shares into rupees 8, 25 by 200. It will be 1,300. So we have seen that there is no effect on the wealth of the shareholder in situation 1 as well as situation 2. Now, what was the situation before the right issue? If there was any difference in the wealth before the right issue? Let us see. Before the right issue, the investor was holding 100 shares. So 100 shares into, and what is the market price? 30. 1,300. So his wealth was 1,300. So even before the right issue and after the right issue, and irrespective of the proportion, whether it is 2:1 or in the first situation it was 2:1, or whether it is second situation it is 4:1, the wealth of the shareholders remains the same in all the situations. So this is how the right shares are valued. I would encourage you to practice this question after this lectures also, because in case of the questions generally come in the examination in regard to right issue as well as in regard to valuation of equity shares also. So you practice this question after this lecture also, and if any difficulty arises you can ask me in my next class. Yatin is asking that if you have to choose one option from the given which is favorable. Yatin, we have seen that no option is favorable option because the wealth on the shareholders is same. That is why you've taken the third situation, that what is the effect on the wealth of the shareholder. If the company is offering one right shares for 2 shares held, the wealth is 1,300. And if the company is offering one right share for 4 share held, then also the wealth remains 1,300. And we have also seen that even before the issuing right shares, the wealth was actually 1,300. So there was no effect on the wealth of the shareholders. And you can say that any of the given options will particularly do. There is no effect on the wealth of the shareholders. So any of the given options will do for the shareholder who is holding 100 shares or any number of shares. Okay, it is clear now. Fine. So let me come to this next section on this. The last section is on valuation of redeemable preference shares. Now, in case of redeemable preference shares, whatever the amount which the investor has invested is generally redeemed back or paid back to him. So therefore, the formula is same as in the case of cost of equity capital. With the only difference that the maturity value is also taken because the amount is redeemed. In equity shares, the amount is not redeemable. But in redeemable preference shares, the amount is redeemable. That is why dividend of first year, which is discounted at the rate. R is basically the minimum required rate of return. In the same way, if, for example, the maturity preference shares is issued for 5 years, then it will be for 5 years. And the fifth year, dividend plus maturity both will be added. And it will be discounted to arrive at the present value of redeemable preference shares. Conversely, in the case of irredeemable preference shares, the dividend is same. And it is irredeemable means there is no maturity value. Therefore, dividend upon required rate of return on preference shares. Let us take a brief example and understand this. It's very simple to calculate after doing this valuation of equity shares. So let us value the preference shares with the help of a simple example, both on redeemable preference shares as well as irredeemable preference shares. Okay, now come to this redeemable preference shares aspect. Give me a second. Okay. Let us take a simple example first. Face value is 10,000 rupees. Face value is 10,000. Let us say dividend is 12%. And dividend is 12%. Redeemable. Say after 3 years. Redeemable after 3 years. And the minimum required rate of return or discount rate is 15%. So let us apply this formula. Dividend of the first year, face value 10,000, so 12% of dividend is 12%. So 12% of 10,000, it is 1,200. So 1,200 upon 1 plus 0.15 plus second year it will be 1,200 upon 1 plus 0.15 square. In the same way, valuation of equity share has been done. In the same way, it will also be done. Plus, in the last year, it will be 1,200. That is the dividend amount plus the maturity value plus the amount. It is also have to be redeemed. So 10,000 plus 1,200 is 11,200. So 11,200 upon 1 plus 0.5 and the present value factor of the third year. That is why it is cubistic. So let us calculate this. 1,200 upon 1.15. It is 1043.47. 0.48. Let us calculate this figure. 1,200 upon 1.15 into 1.15 will come to 907.37 plus third year in which the preference shares will be redeemed. 11,200 divided by 1.15 into 1.15 into 1.15. So it will come to 7364.18. 7364.18. You add all this and it will come to 9315.03. That is the present value of redeemable preference shares. Now, take another example. If it is same example, then continue till the shares are irredeemable. If the shares are irredeemable, preference shares are irredeemable. So P0 will be dividend upon the required rate of return. Same question, face value 10,000, dividend 12% means the dividend will be 1200 divided by the required rate of return. Required rate of return is 15%, so it will 0.15. So 1200 divided by 0.15, it will come into 8,000. So this is the present value in case of irredeemable preference shares. This is the present value in case of redeemable preference shares. So this way the valuation of preference shares is usually done. Fine. Any question on this redeemable preference shares and redeemable preference shares? Okay, fine. So we'll come to this PPTs again. So we have come to the end of this presentation. I have explained to you all the concepts of the valuation of equity shares. We started with their basic concept, that is discount rate, minimum required rate of return, internal required rate of return, equity risk premium, market risk premium. We have questions on every practical aspects. Then we have taken that in case of valuation of equity shares, nominal discount rate is used. And in case of, we have also seen the various methods used in valuation of equity shares, such as dividend discount model, earning-based model, cash flow-based model. In the dividend discount model, basically the Gordon's model is taken into account. And we have also seen that cost of equity capital can be calculated with the help of the Gordon's model, that is risk-free rate, and also the CAPM model, that is capital asset pricing model, in which the this risk is considered. We will take practical questions in the assignment also, in which will be calculate the cost of equity under both the Gordon's model, that is risk-free rate, and the CAPM model, which is in which the risk is taken into consideration. Then we go on to the earning-based model as per the Gordon's model, Walter's model, price earning multiple, in which the basic funda is that in case of growth-oriented companies which declare less dividend, then this earning-based model is basically applied. In free cash flow method, we have also seen that free cash flow to equity and free cash flow to firm. Free cash flow to firm is basically unlevered cash flow, because it is the cash flow which is to be distributed among both the equity shareholders and the debt shareholders. And free cash flow to equity is basically the levered cash flow, because it is the cash flow which is available only to the equity shareholders after paying to the debt holders. And another thing is that the dividend discount model is applicable in case of those companies where valuation is somewhat difficult, in which free cash flow is difficult to calculate. For example, banks and financial institutions, in which dividend discount model is more suitable. And also in case of those companies which are stable, which are at a maturity stage, and which generally declare dividend at a regular interval. So in case of such companies also, the dividend discount model is suitable. Earning-based model is suitable in case of those companies which are at a, you can say, a growth stage, which are actually utilizing its profits in good investment opportunities. And the cash flow model is used in case of those companies which either declare a very high dividend or very low dividend or no dividend at all. Cash flow based model is also suitable in case of those companies which have actually negative cash flows. So these are what is the concept of various models of this one valuation of equity shares. We have also seen the valuation of right shares. We have taken one practical question also on valuation of right shares. Then we ended the session with valuation of preference shares under both the situation when there are redeemable preference shares and when there is irredeemable preference shares. So this is all what about the presentation. In my next session, I will take practical questions on valuation of equity shares. I will share the assignment to you. So I will request you whatever I have taught you today to practice it because I have given practical example for every concept, and then try to solve the assignment questions on your own. I will discuss you in my next class, which will be on 3rd of November, Wednesday, in which I will be taking the practical questions on valuation of equity shares. So, Deva, thank you so much. And thank you, everyone, for your patient listening. Thank you.